If it was to hit 38, that would be like I'd probably close out my position, because not only does it suit what has been happening in this chart already, but it is a really major level where momentum's going to run out.
Yeah.
It'll probably be a big bout of selling. You could pick it up probably, a week or two later at a much lower price. So
Yeah.
I'm still bullish on both of these. And seasonality wise, if we just look at gold, typically June, July, August is when kind of gold, starts to bottom out or just trades sideways. So we will be going into potentially summer type of push higher. As the stock market stalls out over the next month or so, gold could, take that lead and want to push higher as well.
The gold market is holding firmly near the $3,400 per ounce mark as signs of weakening momentum in the U.S. labor market continue to emerge. Disappointing labor data throughout the week has reinforced investor interest in gold, with the precious metal benefiting from its role as a safe haven asset amid growing economic uncertainty. According to ChrisVermeulen of the Technical Traders, gold is currently forming a bullish flag pattern following a brief period of consolidation. This technical formation is often seen as a pause before a continuation of an upward trend. Based on Fibonacci extension analysis, Vermeulen projects that gold could rise to between $3,660 and $3,780 in the near term. These targets are drawn from historical price behavior and recent swing highs and lows, suggesting that the market still has room to run. Thursday morning saw a modest uptick in gold prices, supported by strong underlying momentum. However, investors remain cautious ahead of Friday's non-farm payroll report, which is expected to introduce heightened volatility. The report's outcome could influence expectations for future central bank interest rate policies, particularly those of the Federal Reserve. Looking ahead, the annual average gold price is forecast to surge by 35% in 2025, reaching a record high of $3,210, according to the latest Gold Focus report by Metals Focus. The report cites a mix of persistent economic uncertainty tied to U.S. policy, increasing concerns over national debt, elevated geopolitical risks, and strong demand from central banks as major drivers of gold's bullish outlook. Vermeulen draws parallels between the current market environment and the conditions observed during the 2008 financial crisis, emphasizing that technical indicators and investor sentiment are playing a more prominent role than traditional economic fundamentals. This shift in behavior continues to support gold's ascent as both institutional and retail investors seek stability amid macroeconomic headwinds. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I know from a fundamental and economic, financial kind of standpoint, it's a very different market than 2008, but price action always does the same thing. It's either going up with fear of missing out and people greed, or it's selling off because people are fear of losing more money. So price is either going up or down. It doesn't matter what the news is, but price generally kind of repeats similar price actions. And what's interesting here is we had a high in 2007. The market put in a nominal new high, and then it ended up selling off, and it had about a 20% pullback as that first crack to the downside. And as the stock market was topping in 2008, it had already gone sideways for about a year and a half. And that was gold more or less traded sideways in that bullish pattern. That was when stocks took off, real estate took off, bubbles, it felt like they were everywhere and everybody was a hero making tons of money. Yet just in the final few months of the stock market starting to push to new highs, gold joined in on the rally, and then gold shot higher and became the number one top performer, and everybody wanted gold. And, it's interesting, if I was to pull up the dollar index on here, take a look. If we drop the dollar index on here, the green line, the dollar was down at the bottom. Nobody wanted it. Everybody said the dollar was going to implode, the whole fiat currency scenario. Nobody wanted it. And so if we fast forward to where we are today, we have a very similar type of price action. We have a high on the chart right here, draw. We have a nominal new high. We did see the stock market have a 20% correction. Now we're bouncing up, but just similar to this double bottom and this move sideways. We're having a strong bounce right now. And of course, we have gold trading up. Gold has surged and taken off right as the U.S. stock market was just hitting new all-time highs. Gold's been leading the way. And then if we look at the dollar's in the lower right-hand side again, obviously way off those highs, and it's hated. Everybody hates the dollar. Everybody's fearful that it's going to fall just like previous. So this is a really interesting comparison. Scratch out, what's going on with banking system in 2008 and the housing crisis. If you just look at it as price and emotions are the same. Price is going up or down. People are either fearful of losing money, or they want to make money. And so when you look at the charts, it really does take the news out of things. And that's why I love technical analysis, because I can look at it through the lens of what are people doing with their money? Where are they moving it? Pulling it out of the dollar, going into gold, getting out of stocks, or chasing high-tech stocks or growth stocks. And what's interesting right now is we actually have a lot of people moving into high growth stocks, like the ARK ETFs, uranium stocks. There's a whole bunch of different pockets. Uranium's got a little more news to it, but a lot of aggressive stocks. And that's what happens near major market tops. People move into the aggressive stuff thinking we're going a whole lot higher. Meanwhile, it's potentially the end is near for a big market correction. So, if I was to fast forward, what happens with in 2008, obviously the stock market fell 57%. Gold pulled down naturally with it about 34%. It ended up finding a bottom way before the stock market did. And then, of course, gold eventually took off and shot higher. So I believe we're going to go into something similar, whereas the price of the stock market is eventually going to roll over. I think gold will eventually get pulled down with the bear market in the forced liquidation margin calls. And then I think we'll see it take off and start another major super cycle to the upside. But I think those two comparisons are really interesting because the charts are very similar. They're not identical, but they sure have the same characteristics and the same feeling as the last major market top, the last stage 4, just before we went into a stage 4 bear market. This is the monthly chart of gold. Obviously, it is in a raging bull market still. It's just had a more or less a month pause, and now it's on the verge of popping and extending higher. So I'll just drop to the daily chart, and we can just grab the price action just off this most recent, this standout low on this chart up to this high. Now, this is using Fibonacci extension. This is going to measure to the upside where gold has that potential to run to based on this pattern. So you can see this pattern here is pushing to about 3660 based off this overall pattern. Depending where we want to say that move started, we could go somewhere over here. This is kind of a little bit more of where panic selling hit that stock market back in April, where there was 3 or 4 days where the stock market just free fell. Everybody was dumping shares. And it's a perfect example of how it can hit gold. While gold may be the better play, it still got hit 3 days in a row with big, heavy volume selling. And that's what happens in a bear market. We have extended periods like this, and it'll naturally pull gold down. But more or less, we're pointing to somewhere around this 3660 all the way up to about 3780, somewhere in that range for this next upside target move. So when we look at this chart pattern, obviously it's had a big move up. We've got gold flagging sideways. A flag is known as the halfway point. And so from the low of that flag is usually where that full move could go. And so that's kind of what we're setting up for. So there's a lot of nervousness in the market. If stocks start to fall down, start to struggle even more, people are going to move to gold and flock to safety. And, that's where people tend to go just before we have a big financial crisis. We saw this in 2008. People are worried about the financial system, so they get out of it and they buy gold pet rocks and silver pet rocks to store for a while, right?
ChrisVermeulen has highlighted $38 as a critical resistance level for silver, marking a previous blow-off top and a key turning point from earlier market cycles. According to Vermeulen, if silver reaches this level, it could present a strategic opportunity to exit positions, as a sharp sell-off may follow due to profit-taking and resistance-related rejection. Silver prices surged to their highest level in over a decade on Thursday, breaking above $35 per ounce amid rising uncertainty surrounding President Trump's tariff stance and continued weakness in the U.S. dollar. This breakout marks a significant technical and psychological threshold, driven by both macroeconomic concerns and strong market momentum. Silver began its current uptrend in August 2022, which preceded gold's plus by a month. Since then, silver has doubled in value against the U.S. dollar, nearly keeping pace with gold's 109% increase by posting a 104% rise. On a year-over-year basis, silver's gain now stands at 21%, a notable climb, although it trails the 24.6% annual rise recorded last month, and the 40.2% increase seen in late March. In Europe, silver prices have also shown strength. Euro-denominated silver reached a 10-week high, trading at 31.51 euros per ounce, although it remains 2.4% below the 13.5-year high set in October. The rally in both U.S. and Euro silver prices reflects a combination of industrial demand, safe haven flows, and currency-related tailwinds. Let's get back to the interview.
I think silver's got quite a bit of upside. Obviously, it can move so quickly, but it has a very strong chart pattern. Obviously, it's had a big run up. It's put in a big bull flag pattern. Over the last week and a half, 2 weeks, we've been talking about how it's pushed up into resistance, into these highs, and it's held its ground in a very tight range. That is a very bullish chart pattern. Using Fibonacci extension, there's a couple different targets we could pull off of this. The most conservative target is not using the spike low where it was a washout kind of panic in the market, but to use at least 2 bars, this red bar and where another bar crosses, and same with the upside and the downside here. This gives us a conservative target. So the first target is the golden ratio, which is 618. This is the most probable target that it'll hit. This is generally a spot if I'm trading something like this, any discretionary trade. This is where I always sell some of my position, lock in some profits, and then I move my stop up. If we hit this level and pause for a bar or 2 or 3, however long, as long as it pauses, it's usually a very good sign that we're going to see it go up to this 36.42, which is another pretty good move from where we are. Just from where we are, that's another about 5% move to the upside. Now, if we were to have more of a washout low where everybody piles in and it really gets a lot of momentum, then we can go to the full extreme of these moves. And that shows we should go up to about $38 per ounce, which would be a very strong pop. 10% move from where we are. And if we just kind of go way back in time here, we can see where that matches. We go way, way back here. That's one weird looking chart.
That's the way back machine there, brother.
Oh, yeah. This is going way back there. So here's the weekly chart. This is a little cleaner. Obviously, we're going to potentially hit this target around 38. I'll just draw a line across here. And that brings us right up into this massive blow off top and the hiccup and kind of into this previous high. So there's no doubt if it gets up there, it's probably going to get rejected very, very quickly and sold back down. In fact, we've seen that just in these recent pushes to the upside right over here. You see very strong push and it gets slammed down, a strong push up to another high gets slammed, another push up, it gets slammed. So this is the characteristic we're in. If it was to hit 38, that would be like I'd probably close out my position because not only does it suit what has been happening in this chart already, but it is a really major level where momentum's going to run out. It'll probably be a big bout of selling. You could pick it up probably, a week or 2 later at a much lower price. So I'm still bullish on both of these. And seasonality wise, if we just look at gold, typically June, July, August is when kind of gold, starts to bottom out. Or just trade sideways. So we will be going into potentially summer type of push higher. As the stock market stalls out over the next month or so, gold could, take that lead and want to push higher as well. What is nice about miners at this point is they're actually leading the way higher. They're actually breaking to more or less multi-year highs here before gold is and before silver is. So this is generally we haven't been seeing gold miners perform really well. They're actually coming to life. This is a very good sign. This is one of the main things I'm looking for if we're going to start a new major move up in the precious metal space is for miners to take the lead. So I'm interested to see if they can hold the lead and what happens over the next month or so. But overall, they're now in the outperforming state, which makes them more attractive than more or less gold and silver, than physical gold. So this is a very good sign of what's going on. I mean, volume's not huge. It's not like it's raging or anything and it's getting driven higher, but we are breaking to multi-year highs. This chart pattern, we could draw a Fibonacci extension and get a couple different targets. We could take this biggest one, this last leg up and down to this consolidation. This is pointing that we could see GDXJ run all the way to about 82.30. So from where that is right now, that's about 18%. And typically that makes sense. Usually if whatever gold moves, miners, silver will move twice or 3 times that, and miners will move, multiples as well of that. So the charts are all pointing to all the precious metals and miners are actually pointing to one big, another push to the upside as a defensive play. The fact that they're all moving up right now with the stock market, to me, is actually more of a warning sign that we're closer to some type of financial crisis and a big reset. And that's what we saw in 2008. Gold rallied on that last push up. It rallied with the stock market. Miners are rallying with the stock market too right now. And that is telling us people, they don't care the stock market's going higher. A certain group of people, they're saying, get me into gold, silver, and miners because something bad is about to happen. And so when they're saying forget about other ETFs that are potentially more volatile, they're sticking their guns to this. So this to me is a warning sign. Bullish for precious metals, bearish longer term for the economy. That something ugly, I think, is just around the corner.
As precious metals continue to outperform in an environment shaped by economic ambiguity and shifting investor behavior, gold and silver are exhibiting classic hallmarks of strength. Technical setups, combined with global fiscal anxiety and weakening employment metrics, are enhancing the appeal of safe haven assets. With gold holding firm near peak levels and silver approaching historic inflection points, market watchers are closely monitoring these moves for clues on future price direction. The growing divergence from traditional fundamentals towards sentiment-driven and pattern-based trading underscores a broader transformation in market psychology. Will the interplay between technical patterns and policy uncertainty continue to steer gold and silver toward new milestones? Or could an unexpected policy shift derail the current momentum? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.